Good morning, everybody. Thank you for joining the Bank of Central Florida 2026 shareholder meeting today. We are going to get started. Before I hand it over to Paul, I ask that everybody keep themselves on mute until the end of the call if you would like to ask a question. You can also ask your question in chat, and we will pick it up and we will answer to our best ability. All right. I'm going to hand it over to Paul Norris, our CEO and Chairman of the Board.
Good morning. Thank you for joining us this morning and welcome to our 2026 shareholder meeting. I want to let you know how blessed I feel to be the chairman and CEO of this company, and I want to give you an update on how the bank's doing and things that we're seeing in the marketplace. But first, I'd like to do a couple of thank yous. I'd like to start with you, our shareholders. Truly, without your capital to have gotten the bank started 19 years ago and your continued support, we wouldn't have a company or wouldn't have a bank. So I want you to know how much we appreciate the use of your capital, and more importantly, how many of the decisions that we make here are based on our ability to grow your capital. That's really our number one priority. Secondly, I'd like to thank our board of directors and our executive management team. It's this group of individuals that help develop the strategic plan for the entire company, and it's the executive team's job to execute on that plan. They have done a lot of work throughout the entire life of the bank, but in particular over the last several years as we've managed through a number of different growth opportunities. And so I just wanted to thank them. And lastly, and really most importantly, I want to thank our team members. Without them doing their job day in and day out, we would not produce the results that we do produce. I want them to know how appreciative I am of all that they do for our company. And we just feel very honored and blessed that they chose Bank of Central Florida as their place of employment. And we just want to let them know how appreciative we are. So let me go ahead and talk a little bit on a big picture perspective, just sort of what's going on in the industry and some of the challenges that the industry is facing. I'm not sure we could do a presentation to shareholders without mentioning AI and talking about the opportunities that we will see and have the opportunity to take advantage of over time. I will tell you, as it relates to Bank of Central Florida, we really have not gone too far down this path yet. The challenge we have is that executing an AI strategy is expensive. And so really we have to be smart about the way we do it and where do we think we can get the best amount of bang for our buck. So we're working through those. Secondly, there's non-bank entities that have come about and are growing, continue to grow in the private cap or private lending space. Those opportunities can be challenging and certainly can create an issue for our industry if that segment of the market doesn't do well. So we certainly are keeping a close eye on what we see there and what the impacts might be. Digital currencies is a big topic, especially in the community bank space. As we look to develop a digital currency strategy and sort of how do we execute around that with the opportunities that we have within our bank. The other issue for us is if they begin to pay interest on those digital currencies, that really could have an impact to us on our deposit side. And so we continue to monitor all of that very closely. And then lastly, not sure I could ever do a presentation that doesn't talk about credit quality. Credit quality in the industry right now is still very, very good. But we are seeing impacts from higher oil prices, tariffs, and other issues that are happening at a policy level. And so the impacts and how we go about fixing those over time will be important to our clients and their ability to be a good repayment source for us. So now let me talk a little bit about sort of our bank and how we're doing. We continue to grow the bank. As you can see by the chart, it's nice to see that as we move further in time, the bank continues to grow and get bigger. We ended the year just over $1.2 billion in assets. Very, very proud of the team this year. Did a really good job of not only growing the bank, but really redeploying some of our deposits back onto the loan side. So we're appreciative of the work that they've done as well. From a cash perspective, we continue to maintain high levels of liquidity. From a management perspective, that's really where I like to be. I like to be in 8 to 10% of our assets be in cash. And the primary reason for that is you just don't really ever know whether there are going to be cash needs by our clients. And we want to make sure that we don't get ourselves in a tough position from a cash perspective. We continue to see growth in deposits, which is, fuels our cash position. And we're very, very comfortable with where we are today. As we look at the securities portfolio, there's a couple of things to note here. You can see that actually over the last 12 months, we've increased our level of securities that we purchased, so bonds. The reason that we did that is coming out of the pandemic, we were very, very cash heavy. And you can see that over time, we've dwindled that cash down. At the same time, we were a little nervous to be purchasing bonds because the coupons were still so low. As rates moved up and the long end of the curve moved up, we were sitting on enough cash that we were able to basically reinvest on a monthly basis to make sure that we grew the securities portfolio. Yields in that portfolio today are in that 4.5 to 4.75 range, which for us is a very nice source of enhanced income. And so we will continue to look at growing the securities portfolio modestly. We're not chasing a lot there, but we want to make sure that we're at least replenishing the amount that we receive back. And as we buy bonds, we're rolling up the curve because most of the coupons in the portfolio are in that 1.5 to 2.5 range. So as we collect those payments and we're able to reinvest at 4.5, it's a great trade for us. So you'll continue to see us look at securities as an opportunity for growth. On the loan side, we had a very solid year from a loan production perspective and had some loan growth again. The opportunities that we're seeing in the marketplace, there's a lot of activity. There's also challenges in a lot of the credit opportunities that we're seeing, so we're having to be very selective in terms of how we do that. The portfolio itself is very pristine. We're very happy with where it is. Very, very few, if any, 30-day past due loans. We continue to have great success in our credit selection. And so we will continue to focus obviously on growing the loan portfolio, but do it in a way that leads to a good outcome for our bank and our shareholders. On the deposit side, deposits are a little bit flatter. You can see over the last several years that the deposit growth has been in that 3 to 5% range. It's been a little bit more challenging to grow deposits as competition continues to be strong from our bank and non-bank competitors, really. So it's been a challenge to grow it. One of the things that we certainly have experienced is if you go all the way back to the pandemic, when rates were near zero, the majority of our depositors didn't care whether they were in a checking account or a money market account because basically they weren't earning interest in either account. Now that's changed, and so we certainly have seen a shift from non-interest bearing balances to interest bearing balances. That's been impactful for us over the last 2 years. Certainly has created some challenges on the margin side, in particular from non-bank. The brokerage houses of the world continue to pay higher than normal money market rates. So we continue to have to compete and be challenged by that, but we're happy with the fact that we're continuing to grow deposits, and we have some strategies in place this year to make sure that we're focused on the right outcomes. Probably the brightest spot for us over the last several years has been the earnings of the bank. You can see there that the last 2 years we grew the earnings 25 to 28%. I wanted to spend just a few minutes to talk to you about sort of why that happened and how it happened. If you go again back to the pandemic, and I've spoken about this before, we stayed very conservative. We stayed primarily in Fed funds, despite the fact that they were paying us virtually zero. Our focus at that time was to make sure that we didn't put capital at risk by investing in bonds, and then when rates went up, the value of those bonds go down. So we stayed very patient, and then as rates rose dramatically, we had enough cash that it had a very dramatic impact on our earnings stream. If you go back a little bit further, you'll see that we were growing earnings not quite as quickly. And the primary reason for that, again, was the margin issues related with rates near zero. So we're getting into what I would call a more normal environment where you're having some slope to the yield curve. We're seeing short-term rates in the mid to high threes right now. Longer-term rates on the loan side are in the 6.25 range. So we continue to be able to generate spread as we reinvest our cash back into the loan cycle. So overall, a huge bright spot for us has been the ability to expand some margin because of the change in the rate environment, and really just very, very strong results from an earnings perspective over the last several years. As we look forward to this year, we're forecasting about a 10 or 12% growth in earnings again. So again, a great result, not quite as good as it has been because we certainly are not having the opportunity to expand margin as much as we were, but it's still a very good outcome and one that we're pleased with. So now the slide that I think means the most to our people on this call this morning, our return on equity. And I think it's important for you to note that we continue to grow the returns that we have on the equity side, ending last year at 17.5 or just over 17.5%, which is a very, very strong number. One thing that I do want to point out to you, if you look at the slide, you'll see that we've given you some opportunity to see what the statewide results were in the state of Florida. Those results over the last couple of years have been in that 10 to 10.5% range, while we have been in the 16 to 17% range. So why does that happen? Well, number one, it is a position of the way that we did with the liquidity side, and we're able to get much better returns there, which grew our margins. The second thing is your organization that you own stock in is very efficient with the way that we use our dollars. So not only are we efficient in our capital use, but we also are very efficient in terms of our ability to control costs to make sure that overhead and the cost to run the company stays in line. So we're very pleased with these results. I wish I could tell you that, I thought we could grow earnings 25 to 28% year in and year out. That's just not realistic. But I do believe getting back to the norm of being in that 10 to 15% range is probably what you can expect as we move forward. I wanted to spend a few minutes this morning just talking a little bit about the shareholder base and sort of what's going on the stock side in terms of our valuations. You may recall or may have read that we went from doing our valuation once a year after our year-end results in December to doing it 4 times a year. The reason that the board made that change is we wanted to have a better idea throughout the year in terms of how the bank stock was doing vis-a-vis our competitors and the market in general. So we made that change, and that's been an effective tool that we now are getting a little bit used to be honest. We paid out $1.45 in dividends in 2025. So again, continue to return capital back to our shareholders. For those of you that have been in the stock since the beginning of the bank 19 years ago, we now have returned all of your capital to you. So we now have paid out $10.29 in dividends over that period of time, and that aggregates to about $31 million in capital. So as you look at this opportunity in this particular stock, not only are we growing the value of the currency each year, but we also have continued to provide a very strong dividend return to you as a shareholder. And it's really important for us to manage both sides of that equation. From a capital perspective, I think it's important for you to understand that we do carry lower levels of capital vis-a-vis our competitors. So in general, we carry our capital around 8.5%, and most of our competitors are around 10%. That certainly enhances our return on equity results. So probably some of the return over and above the norm in the market is a result of the fact that we carry less capital, which allows us to better leverage that capital. From a valuation perspective, I thought I would talk a little bit about the 3 different ways that our valuation company looks at our stock. First off, obviously, they're looking at our earnings stream and how are we doing relative to being able to grow that earnings stream. They look at the book value of our company. You can see from the slide that we are trading at a higher book value multiple than most of our peers. The reason for that is that our earnings level is higher than our peers, and therefore that multiple of book is higher as well. And then lastly, they look at what trades have happened and sort of what's going on with our stock in general. We continue to see good demand for our stock. So for those of you that have had or needed the opportunity to sell your stock over the last several years, we have not had any trouble moving the stock to new shareholders. And so we continue to feel very good about our ability to provide liquidity to you if it became important for you to see that. So if you look at some of the impacts to the valuation, again, the geography that we are in certainly has a positive impact to our results and our multiples. Simply being in the middle of the state of Florida gives us great opportunities for growth. And if you're looking at that vis-a-vis other parts of the state and or other parts of the country, obviously we're doing a good job of growing those earnings streams. Lastly, I wanted to talk through just some 2026 priorities. We certainly are focused on deposit and loan growth. That really is the core to who we are as a company. Our ability to grow deposits and loans will always be a high priority for us. We're especially looking to do a better job of growing non-interest-bearing commercial deposits this year. It's a real focus for us. We have a tremendous treasury management area, but we need to continue to make sure that as we prospect, we're prospecting the right type of clients. Client acquisitions, continuing to grow our client base is always a priority. We have done a pretty good job of that over the last several years, but it has to continue to be a focus for us for sure. Our culture is our number one driver of our success. Our ability to continue to expand into Hillsborough County and grow out offices there, and our ability to make sure that they're doing things the same way that we like to do them in Lakeland is very important to us. We did open a loan production office in Brandon earlier this year. Excited about the opportunity to continue to develop a branch network over in Hillsborough County, continue to have better opportunities because we're a little bit more visible and more present there. So we're excited about that. And then lastly, process efficiencies. It kind of goes back to the AI discussion that I talked about earlier. We really are very focused right now on making sure that we are as efficient from a process perspective as we can be. It's really about getting the data that we need to make great decisions in the right place and making sure that that data then can be actionable. We have created a committee of the bank to really focus on looking at literally everything that we do and how can we better and be more efficient with it. And so we continue to work on those issues. It's a high priority for us this year. It's not a short-term project. This is a 12, 18-month type project where we'll continue to be looking for ways to be better. So in conclusion, I just want to say again, thank you to all of our shareholders for the use of your capital, the ability for us to continue to grow the bank. I can tell you that literally every decision we make here is run through the prism of what will that do for our shareholders. If it's not accretive and it's not a good idea for the shareholders, then we're not going to do it. We very much are focused on our ability to grow the franchise. And if we are able to grow the franchise, we know that we will create more value for you. So I want to thank you. I want to thank all of the folks that attended this call. We appreciate the opportunity to serve you, and certainly if there's anything that we can do to help you, please feel free to reach out at any time. So Danielle, that's the conclusion of my comments. I'll let you see if there are questions.
Excellent. All right. If you have any questions, please enter them into the chat or unmute yourself and we will grab your question. Yes. I do have a few folks here. Give me 1 second. So I do have a question from James Lovely. Why the community bank focus on threat from stablecoins? Is that threat unique versus credit unions, brokerage houses, and money market mutual funds?
I'm not sure it's unique, Jimmy. I think it's something that all of us are looking at. The stable coin and the ability for them to pay interest on a stable coin is something that I know that our lobby in DC and at the state level are really paying attention to, because that would have the ability to have us lose deposits. And obviously, if you're in a community bank space, everything that we do here is margin related. We don't have really strong fee income streams. So if we began to lose deposits, obviously that impacts our ability to lend. It impacts our ability to grow our franchise, and so that would certainly be a threat. I can tell you, as of now, it looks like they are not going to allow stablecoins to pay interest, but we continue to monitor that closely and would have to react to that if that began. Yeah, so on the crypto side, you are beginning to see some banks that are getting involved in that. We have made the decision at this point not to do that. There are some folks that are trying to create a easier way for community banks to have access to that, but at this point, that really hasn't come to fruition. And so that's been a space that we have stayed away. The digital currency side, we are going to have to react to that. In my mind, the digital currency is basically a way to move money quicker and more and easier. Sorry. And so that is something that we will have to react to, and we are monitoring that.
Dave Houston, how many Florida?
So great question, David. So when we opened the bank in 2007, there were 415 state chartered banks in the state of Florida. It's hard to know exactly what the number is today, but it's around 50, maybe 55 at the most. So you can see that the landscape over the last 20 years or so has changed dramatically. If you look at banks that are over $1 billion in assets, similar to us, and you take out Dade and Broward County, there are only a handful, I think 5 banks that would meet that criteria of being over $1 billion in assets and not in Dade or Broward County. That was absolutely not the truth when we opened our bank, and so it's changed dramatically over the time. It's certainly created a scarcity value for community banks in the state of Florida. There have been a few new banks that have started over the last 12 to 18 months, and when I say few, 2 or 3, continues to be a very big challenge to raise enough capital to get a bank started today. So I don't anticipate that you're going to see a lot of new entrants into the market, but we are finally seeing some.
And if you have any questions, please go ahead and enter them into the chat. David folks.
It's an interesting question, David, because we really are very focused on our digital platform. We know that that's how people want to bank today. But the reality of it is there's still a pretty large percentage of folks who like to have access to a branch, even though they don't go there very often. And so our ability to continue to provide a very high level of touch while they're in our offices will be a differentiator for us. We are a little bit of a boutique type company, so our branches are don't have lines of 30 or 40 people. It's not normal for us. So we really do focus on that client experience as a delivery channel within that branch. As we continue to expand the bank into different areas, we will always look to establish a branch near a downtown because we really think that that's where we will get the most visibility and the most traffic. So, if you'd asked me 10 years ago, would the branch network still be important? I probably would have said not very important at all. And that certainly has not been the case. People still want to know that if they have an issue and they cannot get it resolved over the phone, they really want to be able to have a branch network that's reasonably close.
Will Henderson, what are your thoughts on private credit issues?
Yeah, that's interesting. I mentioned it briefly in my comments. The private credit side right now is certainly getting a lot of attention. Obviously, we don't have any direct exposure on that, and really our clients don't have a lot of direct exposure in that in general. So we're not sure it's going to have huge impacts for us. Where I worry about it from a bigger picture perspective is, the fact that there are credit issues, whether they're private credit or bank credit, continues to basically play off each other. And so sometimes you'll have situations where you have a client that has a traditional banking relationship from a lending perspective, but also uses private credit. If the leverage on the private credit side is too great and they start doing deals that have a lot more credit risk in them, you could see some crossover into the banking sector. And that's probably the biggest fear that the industry has. But quite honestly, for us, we just don't see a lot of crossover. So we don't believe we'll have a lot of impact.
Any other questions?
It sounds like we have no further questions.
Yeah. I had a question just come in.
Oh, okay.
I did. It's a follow-up from James. As a follow-up, Paul, how is the threat of stablecoins unique versus credit unions, brokers, and money market funds? I understand the margin issue, but I don't understand the specific fear of stablecoins. All these competitors pressure margins.
Yeah, Jimmy, I'm not sure that I could really articulate for you the difference between how it's going to impact a bank versus a credit union versus a brokerage house. Again, from our perspective, it's really about those stable coins are really about trying to make sure that you can move money quicker and more efficiently. And so that's really a lot of where the value is going to come. The question is are they going to pay interest on them? So I can certainly do a little bit more research and reach back out to you, but I'm not sure that I could speak articulately about the differences between those different constituencies. But I'll follow up with you with some additional information.
That'd be
Okay.
great.
I
Thank
think
you.
that's a wrap.
Well, again, I want to thank you for participating in our 2026 shareholder update. Again, I want you to know how appreciative we are for the use of your capital, and our ability to continue to grow that capital is what we're about. So we thank you for the opportunity to present to you this morning and for your continued support. And we thank you and have a great day.